All right, so when we're discussing the trade and risk management, we have to really drill it down to the time frames. And let me list those again. We're talking about the main ones: 15-minute, 30, 60-minute, 240, daily, and I also have a 5-minute strategy. The 5-minute strategy I've outlined in detail over at the Daily Trading Edge blog at ibfx.com. So if I'm looking at a 15-minute time frame, the psychology behind that is a short-term time frame. A 15-minute chart is not designed to reflect necessarily the trend of the week. It's not going to allow me to trade a couple weeks trend or even a month-long trend. It's a short-term time frame. It's a shorter slice of psychology. It's going to actually ebb and flow. It might cycle through the different market trends: accumulation, distribution, markup, markdown, more often than its larger counterparts, your 30, your 60, your 240, or your daily. So when you're looking at a time frame, ask yourself, what is this time frame actually representing? So if I'm looking at a 15-minute time frame, this is the 15-minute across the, actually a couple different, this is the cable and the euro. Let me turn this one into the cable here. All right, so I'm looking at a 15-minute time frame across the cable, the British pound US dollar. This is a shorter term time frame. In fact, one of the things I was looking at on this time frame was the fact that we kept heading up and butting our heads into this area between 52.75 and 52.84. We actually just broke above it not too long ago, and we're coming back to it a little bit, but we were butting our heads against this particular area. It was resistance. It was a ceiling. Now the market trend did carry us up there a number of times, but then it would transition, move sideways, sell off, and come up again. This has been a range-bound market on the 15-minute chart. Now if I change this over to, say, a 30-minute chart, you can still see that price action, those highs, the trends, right? What if I switch this over to a 60? Those trends aren't as clear, are they? Those very dramatic uptrends we saw in the 15 and 30, they're a little less dramatic on the 60, right? Now think about that for a moment from a risk standpoint. One 60-minute candle is 4 15-minute candles. Things are going to look more dramatic on a 15-minute chart. They're going to look less dramatic on the 60. But this market is still range-bound, correct? But the view is much, much different in terms of the different market cycles that the 60-minute transition to. What if I head on over to a 240? Now we're talking about a 4-hour chart. Those up and down trends, they're hardly even visible, are they? And I can get rid of these get rid of those numbers there, but those up and down trends we saw very clearly on the 15, clearly on the 60, much less clearly on the clearly on the 30, much less clear on the 60, and then now we bring it over to the 240. Those up and down trends, those mark up and mark down cycles where the wave was angling up and then down, it's not even visible on this 240-minute chart, on this 4-hour chart. And what we're seeing is really all 4 of these intraday time frames saw the same price action, did they not? I mean, we made the same highs, lows, and so forth on these time frames. But the difference is the number of candles that represent the movement. All right, let me actually show you on a chart that does not necessarily have the chart pattern overlays. We don't necessarily need those right now. So here's a 15-minute chart, and what I have running on this 15-minute chart right now is the grab plugin, my green, red, and blue. Just so you know what you're looking at here. This is simply a plugin that takes the candles and shades them according to where the close occurred. So if I have red candles, that means that these candles close below the 34-period exponential moving average on the low, or this red line here. When they close blue, that means they closed inside the 34-period low, the 34-period high. The high is in green. And when they plot, and the candles are plotting in green, that means that candles closed above the 34-period EMA on the high. So these three lines, 34-period EMA on the high, the close, and the low, that makes up my wave, and that's how this plug-in determines what color to shade these candles. Okay. Additionally, if I have a candle that closed up or down, it's a lighter or darker shade of that color. So light green is an up candle, dark green is a down candle. And this is just a visual indicator, okay? This is nothing, there's nothing proprietary or fancy about it, other than the fact that I think it highlights trends and strength, in my opinion, much clearer than just a normal candlestick chart. Okay, here's basically that same chart with a more traditional hollowed out and shaded in candle versus the view with the grab, where I think I can much clearly see when the market strengthened, went neutral, and then went weak, as opposed to this view. Same time frame, same chunk of data. Okay, just very different, I think, visually. Okay. All right, so having said all that, 15-minute chart, again, think about why the 15-minute might look so much different than the 60. It's the number of candles. If you have a single chart, let's say we have a daily chart. Let's look at the daily chart of the cable here real quick. All that movement that we saw up and down through the past few trading sessions, it's just this amount of data right here along the hard right edge. Okay? Right there. All those up and down, the very dramatic market cycle shifts on the 15 are just these candles right here. So that dramatic move higher, then lower, then higher. Think about how many 15-minute candles go into a single trading day. If I have four 15-minute candles every 24 hours, how many candles is that? That's 96 candles per day. So 96 candles on a 15-minute time frame is going to give me a whole lot more shorter, but a whole lot more movement as opposed to one daily candle. The setups on a 15-minute chart, because of that shorter time frame, will be smaller. Okay, the high to low range for an entire day of 15-minute candles and the high to low range for one daily chart candle might be the same, but the way the market moves and the way, therefore, we see the different cycles is very different. Okay, so when you drill down to the different time frames of the same pair, the price action might, at the end of the day, be identical, the open, high, low, close, right? But the movement we're going to see, depending upon how you dissect it, makes a huge difference. So, when we look at any pair, I'm going to look across multiple time frames. Again, my main time frames are 15, 30, 60, 240, and the daily. I also trade the 5-minute chart sometimes. I don't go any lower than 5. That's just my preference. So I've got these these main 5 time frames. I've got the extra 5-minute, which is my 6th, and every one of those time frames is going to shed a different light on the psychology of the market. So hopefully we can agree on that. The smaller time frame, typically, because the patterns will be smaller, the area between support and resistance will be very different. Imagine 30 15-minute candles. 30 15-minute candles is barely a third of the day, right? Imagine 30 daily candles. That's almost a month. Do you think the market's going to move in a wider high to low range over the course of a month? 30 candles than, say, 30 15-minute candles? Does everyone follow me here?